Go for it.
Okay, so obviously, pretty interesting week in the markets to say the least. I started off the newsletter talking about inflation and CPI. So obviously, yesterday we got October's CPI numbers from the Bureau of Labor Statistics. Just a quick recap: headline CPI came in at 7.7% year over year, in comparison to September's 8.2%, and also lower than the consensus analyst estimates of 7.9%. Core CPI, which is CPI minus food and energy, which are the two most volatile pieces, came in at 6.3% year over year, which was also 20 basis points lower than the estimates of 6.5%. When we look at a month over month basis, October headline CPI rose by 0.4%, which was also lower than analyst estimates of 0.6%. I want to talk about three charts with CPI, and I posted them on my feed. It's the most recent tweet on my feed if you want to look at them while I talk about them. But the first one is just looking at headline CPI month over month change, just looking at all items. So what you can see on the chart is that we've now seen 2 consecutive months of increasing CPI when compared to the previous month. So in periods of prolonged inflation, I think month over month data can be really insightful. And the reason for that is because if we look at October 2021, we had a month of rising month over month inflation, and it was at 0.8%. So because currently CPI or prices in the CPI basket are higher than they were last year, we're still going to see that highly positive year over year CPI inflation number. But we're going to start to see that year over year change decline because the month over month change was higher a year ago. So it can be a little bit misleading when you look at, has inflation peaked? And maybe since a year ago, we're not seeing inflation increase at the rate that it was. So you're going to see that declining year over year value. But on a month over month basis, we've now had 2 months of increasing CPI. So, I think in October 22, prices rose from September. So I think that's, potentially a cause for concern. And I think, yes, that increase was smaller than the market was expecting. But I think increasing month over month values is probably not a trend we'd want to see continue. If we zoom in a little bit to look at those specific components that make up CPI, we're seeing that in the month of October, shelter costs continue to climb. This is another chart that's on my feed there in that most recent tweet. But the shelter component of CPI is interesting, and it's not a measure of like market prices for houses or the price to buy a brand new house. Instead, we're looking at the cost of housing. So you're looking at things like rent and utilities. So what the chart shows is that the month over month increase to shelter costs in October was 0.75%, which was the highest month over month change since August 1990, and that was 0.79% at the time. So, as we looked at in the newsletter a lot, I've talked about it probably 4 or 5 times now, but we're seeing a decline in average housing prices, like the price of a new house, which we measure with the Case-Shiller index. But what we often see is that in periods of falling home prices, rents will actually increase. So I think overall rent payments are generally pretty inelastic. So if you look at periods like 2008, 2009, rent payments and rent costs didn't really change that much. But in periods where you have mortgage rates that are rising very quickly, like they are today, it's not too surprising to see that landlords are going to pass that rising cost of capital down to their tenants. As I mentioned, the U.S. 30-year average 30-year fixed mortgage rate is hovering right around 7% at the moment. So it makes sense that less American consumers are interested in buying houses, and then therefore the cost of owning or renting shelter is rising. Furthermore, that shelter component takes into account utilities, as I mentioned, and only utilities that are included in the tenant's lease. But if we look at that CPI energy component, we're seeing a year over year decline as well in comparison to September. But once again, we're seeing an overall month over month increase in energy prices. That third chart on my feed is what I'm talking about now. And that chart shows 4 different components of the CPI market basket. So in red is the energy component, which is kind of an aggregated composition of electricity, gas, and oil. So we can also look at the month over month data for those 3 specific types of energy. And what we're seeing is that in the month of September, we saw a 10% decline in WTI crude oil price. That's that spot exchange rate. In October, prices were back on the rise and they recovered about 8%. So, in total, in summary, if we Look at according to Bank of America, the top three monthly expenses for the average American are number one housing, number two transportation, and number three food. So in October, spending on food rose by about 0.6% according to those CPI numbers. So in summary, I think kind of one sentence to summarize everything we saw from that CPI report yesterday would say that while declining year-over-year CPI values are a good sign, in the month of October, Americans saw increases to their three largest expenses on average. And I think that kind of just summarizes, everything I've talked about for the last few minutes. So now that we kind of have an idea of what October's CPI was like, I think the next question to ask is, how are the markets reacting? So obviously, as I mentioned, it's obviously been a crazy week with the crypto liquidity crunch kind of spilling over into the equity markets on Wednesday. And I thought at the close on Wednesday, it seemed almost certain that lower prices were to come for the major indexes. They had just a terrible price structure. Price action wasn't great on Wednesday, but obviously that lower than expected CPI bailed out the market yesterday, and we saw this massive 7.35% bounce on the Nasdaq, and it ended up becoming the best session for the Nasdaq since March 24th, 2020's 8.12%, which for the record was the day after the market bottomed in 2020. In fact, furthermore, Thursday's 7.35% was the Nasdaq's 14th best session of all time, which I thought was interesting. And there's a Excel table included in the newsletter that shows you all the other 13 better sessions. I think this could potentially be a signal that market participants believe that inflation truly has peaked, and that buying on Thursday would be the result of expectations of lower future interest rates. That being said, I don't think one day of price action or today, a day and a half of price action is enough to kind of make a blanket statement like that and say that inflation has peaked and that the market has bottomed. I just think it's much too early, but it's definitely interesting. Something else that I found interesting was that on Wednesday, the ARK Innovation ETF, which is ARKK, officially undercut its 2020 lows of $33. So on Wednesday, ARK reached a low of $32.51, which put it at a price that we hadn't seen since 2017, which I thought was interesting. And I thought it was a pretty indicative of what the average growth stock has done over the last 2 years. So I should say not all of them, a lot of them topped even in spring of 2021, right? And especially those crypto exposed equities as well. They topped in spring 2021, and a lot of them have retraced all of their gains from 2020. And so Thursday's gain from the stock market also kind of coincided with the most significant single day rally for treasury prices that we've seen since February of this year. So on Thursday, the yield of the 10-year fell right to about 3.8%, and every maturity treasury, excluding the 1 month, saw a rise in price on Thursday. So with that fall in yields, we're also seeing a decline in the U.S. dollar, and I use the U.S. dollar currency index. The ticker is DXY, the Dixie. And so, like I said, we're starting to see that fall, and I think there's several reasons for this, right? There's some things going on in the German bond market, but I think one of the biggest connections we can make is that this drop in yields for U.S. debt means that we're going to see less demand for dollars, right? Less people are going to want to hold U.S. debt because the yield on that debt is falling. So you're going to see less demand for dollars. So, if you read the newsletter a lot, you probably already know this, but this combination of declining yields and a declining dollar is historically very bullish for risk assets like stocks and Bitcoin. So that kind of sums up everything I talked about for the general market update section. For the crypto exposed equity section, I got a little bit into kind of that FTX Binance situation. I'm not sure if any of you guys have heard of it, but we talked a little bit about that and just kind of what this could mean for these public Bitcoin miners and crypto exposed stocks. Talking just a little bit about counterparty risk, which I think is kind of the big takeaway that I've taken from this whole situation, at least from an equities perspective, right? Equities are risk assets, and a major reason for that is because of counterparty risk, right? Over the long term, the return associated with buying and holding shares of a company comes down to the ability of that company to turn equity financing into profits, right? So when you have companies who have poor balance sheet strategies, or you have unethical actions from your executives, you can obviously send a company spiraling. So I think this has kind of been an eye-opening period of time for investors, and it's pretty interesting to see what's going on in the market. But I'm not going to get too much into all of that, I would recommend going and reading the newsletter. I want to save some stuff for the readers. We also get into Bitcoin technical analysis as well, but that's about it.
Blake, do you think Treasury yields in the Dixie have peaked?
That's a good question, because that's if Treasury yields and the dollar have peaked, that would mean that the market has bottomed essentially, or that's what will happen when that happens. And I don't know, honestly. I based off of what we're seeing from equities the last 2 days, they're kind of acting like, or I should say, a lot of the growth stocks are acting like they've peaked. But whether or not that's actually going to be the case, I have no idea. If I knew, I'd probably be living on an island, retired somewhere. So I would wager, just based off of the trend, right? So in these cyclical bear markets, right? I try not to fight the trend. At least me personally, and this is sort of my investment strategy, right? I'm not trying to give anyone advice, but I don't like to fight the trend, and the primary trend has been down for almost a year now, or just about a year now, actually. Yeah. So the primary trend's been down for about a year now. So I try not to fight the trend until we have clear validation that this trend is switching, and I don't think we've necessarily seen that yet. So from a personal perspective, I'm behaving like they haven't, but I really don't know.
Nice, Blake. I think that makes a lot of sense. Would the same idea kind of apply to CPI? Like if we continue to see the annualized CPI rate trend down and the month over month growth either slows or goes closer to zero, would that also likely imply that the bottom is in for U.S. equities?
I think yeah, most likely. Obviously, anything can happen, and crazy things happen in the markets. And if you look at that year over year CPI, if you look that up on a chart, we've seen periods in the past where you start to get a declining year over year value, and then it keeps heading back higher. But I think it would most likely, you would most likely see the bottom of the stock market in the bond market, and crypto even too, before, or maybe right around then, because when you see that declining year over year CPI value, that's kind of a signal to the Fed that they can start to ease back on their contractionary monetary policy. So the market operates on future expectations. So when you start to see declining inflation, you're going to also see expectations of future interest rates declining, which is going to bring bond yields lower and stock prices higher, generally speaking. So I think, to answer your question, most likely those two would coincide, but it's not necessarily a given.
Yeah,
Like,
that makes sense. Oh, go ahead, Mitch.
I think the best signal you've got in here in this week's edition is the increase in shelter and food costs, because those are sticky expenses. People they need a roof over their head and they need to eat. So if that's going to take up a larger percentage of people's day-to-day income, then they're not going to be able to really spend money on other stuff as much. So that I think that's a strong signal that we're getting deeper into or near a recession.
Yeah, totally. I think in my opinion, I think the chart that I included with the energy components is most interesting, because energy is an input to everything, right? So the reason food costs are rising is because our energy costs are rising. And the reason shelter costs are rising, a lot of which has to do with the price of energy and in mortgage rates. And shelter costs are a pretty lagging indicator. A lot of these economic data points are lagging indicators. So they take several months to catch up to what's going on with the market. So the fact that we're starting to see these shelter costs rise, and they're rising at a very aggressive pace, if you look at the chart, I think is interesting. And it's kind of as I mentioned, it's a lagging indicator. So potentially we could see a lot higher shelter costs here in the U.S., especially if we start to see kind of an unwind in the housing market.
For sure. On that energy chart you're talking about, I don't know if you see this too, but when I'm looking at it, like these spikes, they're getting more volatile in either direction, right? The month over month change in energy costs, and that volatility in energy markets surely can't be good for people determining, because prices are just information, right? When the prices are so volatile, it's harder to make rational economic decisions.
Yeah, totally. And I think, on the mining side, I think that just kind of reiterates why it's so important to be hosting your rigs, with someone with a fixed energy cost.
No doubt.
So yeah, that about sums it up. If you guys have any more questions for me, I'm happy to answer them. If anyone listening has questions, my DMs are open. But Mitch, you could take it over if you want.
Oh, yeah, I do have one more question about the ARK ETF,
Yeah.
and it's crazy that it's back to it's 2020 bottom. Is that Do you look at ARK as like just the biggest like risk on asset? Like if that was like a cohort, do you look at that as like the main one, like the most embodiment of risk on assets?
Yeah, I mean, really, the embodiment of risk on assets is all the shit coins. But from the stock market, I look at ARKK a lot, and I also like to look at the Russell 2000 growth ETF, or just the Russell 2002. So you can look at IWM, which is the Russell 2000, or IWO, which is the Russell 2000 growth. But they're remotely similar to ARK, but ARK's just obviously had a rough kind of go at it the last year or so. But I think Kathy Wood is great. I just not too sure what's going on over there.
For sure. That ETF being so low, would you say that that's the market definitely pricing in low growth expectations going forward for like
Yeah,
short?
100%. I mean, she kind of bottomed. They bottomed early, but they really rolled over in September last year, which was kind of right around when the Fed was talking about, hey, we're moving towards this contractionary cycle. It's coming. We're going to see higher rates in 2022, and that's when ARK just really rolled over and hasn't really been able to rebound since. I think. I talk about it in the Bitcoin TA section this week, but there's this pattern that I really love. It's called the undercut and rally, and it's a very common pattern, and it's something that you tend to see around bottoms. So it's kind of what Bitcoin did this week. Hasn't fully validated the move to the upside following that pattern. But ARK that's what we're seeing in ARK this week, and it's when you undercut these major support levels. So a lot of times what happens is like these really big institutional investors or big whales in the Bitcoin space, or it happens across markets, but you'll have them sell the stock down, or the Bitcoin, whatever, sell the stock down to undercut a major support level because they know that's where all these investors have stop losses sitting. And then, once they blow through all these people's stop losses, they just accumulate all those shares that were just automatically sold in price rebounds. So I kind of think, that's what's going on here with ARK. And, it's had a strong last couple of days. Yesterday it was up almost, 14.5%. Today we're up another 5%. But it's definitely interesting. And I just, like I mentioned in my monologue earlier, it's kind of indicative of, what a lot of growth stocks have done and a lot of risk assets have done over the last couple of years.
Great analysis. Like we can move forward to on chain. So I'm not going to rehash too much of the FTX situation. There's a lot of people been covering that all week, and it's a developing situation. I'll give the high level. So obviously, FTX is playing with funny money. They made their token and they levered against it, even though it wasn't really high quality collateral. And they're rehypothecating user funds, being very risky, similar to what we saw in the earlier contagion of the summer. So what I'm really looking at this week on chain is self custody, because it's become to the point where when people ask me about Bitcoin, and it used to just be like, oh, the only thing I would really say is like, oh, it's absolutely scarce, like you need to get some. And now, like, I felt like that was the most important point to make when people ask me about Bitcoin, and now I feel like I just have to include private keys, like, because if you're not taking self custody, you're not actually getting the benefits of Bitcoin. What we've seen with these exchanges is exactly what goes on in the fiat system: rehypothecation of deposits into risky investments. So if you want to move away from that, you absolutely have to self custody. So that hopefully we don't see any more contagion. I mean, obviously the fallout from FTX has not probably not fully played out, but as long as the trend has been is people, entities, users, Bitcoiners taking their Bitcoin off exchanges, and that was exasperated this week. So I'll go through the on-chain data talking about that. The first on-chain chart I put in the newsletter this week was just the blocks mine, because I want to emphasize, all of this going on in crypto doesn't affect the Bitcoin protocol. You're going to see on mainstream media, the talking heads, people in your life probably ask you, oh, what's going on with Bitcoin because of what's going on in crypto. So, we understand that those aren't to be conflated. The Bitcoin network's operating fine. The volatility is coming from the speculators and the Bitcoin adjacent industry. The realized volatility, the last few weeks have been following the newsletter. We've been expecting a big move, and this is pure speculation here, but had this FTX situation not happened, I believe that move probably would have been to the upside, and we could be sitting around 22 to 25K. But cheaper sats is fine by me personally. So we saw volatility spike up, and we saw the open interest spike down, which is indicative of a liquidation cascade. And I tweeted this chart the other day. It's the supply held by entities with 0.01 to 1 BTC, and it has just spiked tremendously, and it continues to all week. Over 8,000 Bitcoin have been stacked by these smaller guys. So in the long run, reallocating Bitcoin from risky exchanges to prudent retail investors is fine by me. I think that's great for the long-term health of the network. And you see the same thing with the supply held by entities with 1 to 10 BTC. Obviously, in the future, that's going to be a lot. 10 BTC, people are going to be foaming at the mouth to get 10 BTC. But for now, that's still like relatively smaller-ish cohort. But we saw a huge spike in that group stacking as well, 1 to 10 Bitcoin. And some people might say this isn't stacking. This is just people taking off exchanges, and to that I would say that's the exact same thing. I went on a little tangent earlier about private keys. You don't actually own Bitcoin unless you take it off the exchange. So you can buy it on the exchange, but you have to self custody it before I consider that you've actually bought Bitcoin. Exchange outflows, they saw another spike this week, the biggest spike since earlier in the summer. So again, that's reiterating what we're seeing is people are learning. I guess the people now are learning the hard way that you have to self custody. So you're gonna learn regardless. So it's better to not take a huge financial hit when you learn that lesson about private keys. And what we see, this is the first time this has happened on chain, is exchange withdrawals have been greater than exchange deposits, which again, super bullish. We need people taking private custody. Like if we want Bitcoin to do what we want it to do, that's non-negotiable. And what you see during the bull markets is obviously you're going to see a lot more deposits than withdrawals because people, they want to take fiat profits and whatnot. But during the bear markets, you see deposits and withdrawals tend to get very close nominally. And this hasn't happened in a past bear market where withdrawals have outpaced deposits. So that's great to see. And we've been talking about realized profit and loss adjusted for market cap the past few weeks in the newsletter. And this spike down did not really have huge realized losses, not nearly as bad as earlier in the summer. So the trend we've been looking at is at the very bottom, the start of the bottom of the bear market. You see the massive bloody capitulation, lots of realized losses, and over time throughout the bottom of the bear market, the intensity of the realized losses decreases. So this adds to that hypothesis that we're closer to the end of the bear market bottom than the beginning in time wise. Obviously, we're at a lower price, but I think time wise we're closer to the end. So, and I think looking at the realized losses supports that hypothesis. And then the last chart is the short-term holder realized price. I was talking about how that was going to be a big resistance level going forward, and obviously we didn't break through it. I tend to think if this situation hadn't happened, we probably would have. But in the long run, it's great that this happened, because it's better that prudent, hardcore, laser-eyed Bitcoiners hold more of the Bitcoin than FTX, who's going to leverage it out and trade against it. So that's all I've got so far. Joe, Blake, if you guys got any comments, fire away.
Great analysis. I did have a question that I've kind of been thinking about a little bit. I know back in June, Bitcoin's low was 17.6K, and right now we're 16.8K, which is pretty much like 4 or 5% off the June low that Bitcoin had, and kind of given how much, implosion that we've had in the crypto industry, I'm sure so many different parties are liquidating whatever assets they have to, stay solvent or go into bankruptcy, and they have to sell their assets anyways. Are you surprised that we're only, 4 or 5% off the previous low?
I think most people probably would be, but I'm not necessarily, just because, a lot of the on-chain metrics show that most of the Bitcoin is in the hands of long-term holders, right? We've really shaken out the short-term traders and the speculators from a lot of their holdings. So there wasn't a whole lot of Bitcoin necessarily that could be sold down here in an event like this. Obviously, there's still some, but I think it's a great sign that we're not that far off from the previous low. Considering, I think a lot of people would have expected more, considering how big FTX is, right? If you would have told somebody a few months ago that FTX was going to go belly up, I think a lot of people probably would have expected another $10,000 drop down to 10K, and we didn't have that. So I think that's a great sign.
Yeah, I think that's a great point. I definitely think equities, having a great day yesterday, having a decent day today is obviously, helped Bitcoin. But yeah, I think it's pretty impressive that Bitcoin is not super far off its low from the summer. One other question that I wanted to ask, I've seen like CZ posted a tweet about how Binance and even other exchanges are likely going to start doing proof of reserves in the future. And I've seen, some people in the community kind of say like, hey, like this isn't this, I mean, it's not really going to solve anything. Like what's your opinion personally? I mean, I'm I don't think there's necessarily a right answer, but it is interesting that, there's kind of a debate over whether proof of reserves, will help, or if it's just like, hey, you need to take self custody, and like that's the end of the story.
I'll be honest. I don't know too much about how proof of reserves works technically, but I definitely would agree with your last statement there, that just self custody regardless, right? Maybe they can prove that it's back to 1-to-1 on chain, but still, like, they could do anything in the spur of a moment. So if it's your life savings or even just a significant amount of wealth, I definitely, like, you gotta self custody that. If maybe you wanted to use a little bit of Bitcoin as like a checking account on something like a Strike or a Cash App, where you're using that to make day-to-day payments, right? You're off of zero fiat, as they say. Then that's fine. The amount you would carry in your wallet, if you're gonna walk through the hood, right? You don't want to leave more than that amount of Bitcoin on an exchange.
Yeah, I think it's a couple great points for sure. And yeah, I mean, I think as far as proof of reserves, as far as I know, there's not really like a standard for how to technically do it. And like, I'm sure there's kind of like a range of how you can prove your reserves, right? Like if Binance just posts an address and says, hey, like here's 500,000 BTC in it, I mean, doesn't really necessarily help to know that, hey, as a user, I have access, or like that's my Bitcoin, like I have a claim on that, and no one else has a claim on that 500,000 BTC. So it's hard, but also, I mean, you could do things like a collaborative multi-sig, like Unchained, in a way. Like if you borrow against your Bitcoin, that's somewhat of a proof of reserves, like, because you don't have control of your Bitcoin. You have one of the three keys, and you need two to move it if you're borrowing against your Bitcoin using their product. So in a way, that's proof of reserves, but you kind of have a lot more visibility over your assets. So it's just an interesting. I guess there's like a spectrum of what proof of reserves actually means to different people.
For sure. That's a great point, Joe. I'll pass it over to you with the mining, and actually, there's one more point I kind of wanted to make. Like, this might sound pretty harsh, but if you left your Bitcoin on an exchange, you sort of only have yourself to blame, right? We've already seen this happen before. We know what can happen when you leave your Bitcoin on an exchange. So at this point, the only people who I feel have been, like, unduly harmed by this price wick down is the miners, right? They had their margins slashed, and it wasn't really any fault of their own. But the ones that are most efficient will come out on the other side just fine. So, anyways, I'll pass it over to you with the mining.
Yeah, sounds good. And yeah, I mean,
tough situation for a lot of people. But yeah, I mean, Bitcoin is technology that demands personal responsibility, and if you fail to take personal responsibility, then you are going to bear the cost. There's no lender of last resort to help you out and fix that, unfortunately for some people. But that's just the way it works. Yeah, I'll transition to mining. So there's basically four key topics that I'm going to talk about today, and they're all in the newsletter. The first one is about Shell sponsoring the Bitcoin 2023 conference in Miami. Shell is one of the largest oil and gas companies in the world, and it has now basically sponsored the largest Bitcoin conference in the world. And Blockware Intelligence, we've been talking about this for some time now about how the energy industry and the Bitcoin mining industry are basically on a collision course. And I think this is likely just the beginning of this collision. I think really in the long run, it's very logical for an energy company to vertically integrate its operations with the Bitcoin mining sector, because I think very concisely, I guess, Bitcoin mining basically offers this time and location independent bid for nearly an infinite amount of energy. And energy companies typically have excess wasted energy that either gets flared or ignored because they always have to overproduce. Because if your house, you can't turn on your light, like that's a problem. If the hospital can't run their machines, that's a problem. So they have to constantly be overproducing power. So a lot of power and energy gets wasted. I think that's where Bitcoin mining can come in. But this Shell announcement is very interesting because it's such a large company. They currently on their balance sheet they have about $37 billion worth of cash, and I don't think there's currently pretty much no evidence at all of active discussions with their M&A team trying to get into the Bitcoin mining space. And I think it's very unlikely that's going to happen soon. But it is interesting, and I think that's something that they should probably consider. And just to put in perspective the size of how big Shell is compared to the Bitcoin mining industry today, if they use their cash position right now at the current market price of Bitcoin, they could basically obtain about 2 million Bitcoins, which is obviously absurd. If they actually try to buy $37 billion worth of Bitcoin, the price would soar overnight and they wouldn't get that many Bitcoin. But it's just kind of showing the perspective of how large Shell is as an organization. And obviously, probably won't be buying Bitcoin anytime soon, but that's just kind of showing the size. Another thing that they could do potentially is acquire some of these public distressed Bitcoin miners, and again, just to show the magnitude of how big Shell is compared to the mining industry, they could acquire Core Scientific, Mara, Riot, Hut, CleanSpark, Bitfarms, Iris Energy, and Mawson many times over. Like they would still have excess cash if they bought those companies twice per se. Which is pretty incredible. Like this is a very large company, getting involved in the Bitcoin mining space, which is very exciting. Second key topic that I talked about in the newsletter was something called hash price. So I've talked about it many times before, but just for the audience, if you haven't heard about what hash price is, it's basically a metric that measures the dollars a mining rig earns per unit of terahash per day. So, for example, an S19 XP may run at 140 terahash, and today's hash price is about 6 cents. It's basically 5 cents, 0.058 cents, and that machine at that hash price, which is today, earns about $8.12 per day, and that's just multiplying 140 times the 0.058. But hash price is basically this metric that's used to measure how much revenue rigs are generating, and it basically hit an all-time low as of yesterday. So this is just another metric pointing out the extreme stress that many miners are currently under, and the reason it's so low is for two variables. It's a lower Bitcoin price right now, and it's a high mining difficulty. And in the long run, or
in the short to medium term, I think that's going to change at some point. But there's definitely extreme stress for many miners. Um, Another cool chart that I put in the newsletter, or table, I should say, is basically an updated rig break-even price breakdown. So it shows the different mining rigs that are, hashing and available in the market. We have, Bitmain S9, we have the S17, we have the S19, and we have the S19 XP. And it breaks down their Bitcoin break-even price at different electricity rates. So you can see for the most part, if you're running an S9, you're pretty much unprofitable unless you have nearly free energy. But the interesting thing is if you're running an S19 XP, even operating at relatively high commercial electricity rates or high hosting rates, you're still extremely profitable right now. And the interesting thing kind of about that is if the price of Bitcoin, does go lower and we do go to 10K, it would be very interesting to see what happens because a lot of, S17s and S19s and the what's miner equivalent of those machines will likely start to get turned off. So the S19 XP, the Bitcoin break even price would actually start to go down because mining difficulty would be going down if the price does go down. So in a way, the S19 kind of has this natural hedge against further price declines in the price of Bitcoin. Very last topic that I mentioned in the newsletter is kind of this idea of like, okay, why has Bitcoin mining difficulty not significantly fallen despite this massive price crash? And I'm not just talking about the price crash over this week. I'm talking about the price crash, since the beginning of last year, right? I mean, Bitcoin is down well off its all-time high, but we've seen hash rate and mining difficulty, which are one-to-one correlated, continue to go up, which is quite fascinating for a lot of people. But I think it's important to point out that you can't plug in massive amounts of Bitcoin miners overnight. So in 2021, a lot of companies were placing, orders at Bitmain for machines like the S19 XP, and they aren't delivered until, summer of this year up until the end of this year. So it's kind of been done ahead of time, and I think that it's going to continue to to um, to kind of have a delay. There's kind of this like delay in price. When the price goes up a lot, people are deploying capital into mining, and even when the price goes down, that capital was already deployed, and many miners are still deploying lots of rigs. And that's basically it for the last section. Happy to answer any questions. So
This shell announcement is huge. I don't think anybody outside of the Bitcoin and energy communities realizes the significance of it. So I think a point that is worth noting, and I don't like to. Bitcoin is bigger than partisan politics, right? And I don't like to really intermingle the two because Bitcoin is separate from all of that. But if all these big oil and gas giants start, getting involved with Bitcoin, they're going to have a huge incentive to help fight against any hostile political legislation. So I think, aside from them actually mining Bitcoin and securing the network in that regards, I think having, them as an ally against bad politics will really help Bitcoin in the long run.
oh,
That's
for
great,
sure.
man. I didn't even like really think about it that way. Obviously, we've been talking about, energy companies, getting involved in the Bitcoin space for quite some time now. And, us three internally have talked about it a bunch, but I never really weighed or, took into consideration how much, sway these type of companies have over, government and politics. So I think that's really interesting and a really awesome point.
Yeah, definitely. I mean, I think it's just further evidence that Bitcoin is going to further entrench itself into various industries throughout the world, and mining the energy industry is probably like one of the most obvious first steps for the Bitcoin industry to just really grab its arms around and further entrench itself.
For sure. And this is just it's an objectively positive tool. We say Bitcoin fixes this about a lot of things, and that's sometimes it's a joke, but it's not always a joke. It does fix a lot of things, and people who and industries that see Bitcoin fixing their problems, they're going to fight for it. So I think, over time, we're just going to see more and more people personally benefit from Bitcoin, and their incentive is going to be to, see it prosper, and that should pan out to a lot of the, politicians, as they don't always have the interests of their people in mind. That tends to be rare, but personally, they're going to be incentivized for Bitcoin, because Bitcoin just helps everyone, even them, on an individual basis. So I think, the energy companies adopting Bitcoin is going to be the obvious first step, of, Bitcoin fixing the world. And I think that'll happen before we see it totally revamp the financial system.
Yeah, I totally agree, Mitch. And, like if you talk to like Saifedean, obviously he would say that Bitcoin could fix a ton of things, right? Like he talked in the Fiat Center, he talks about education and food production and all these things that a decentralized financial system could help. But I think for energy companies, I think fixing that energy space, or at least aiding the energy space, is kind of one of those first obvious moves. And I think the fact that this week we're kind of seeing that. Play out actually for real is super interesting, and I think it's really bullish for Bitcoin over the long term.
For sure, and the reason it's happening first is because it's price agnostic, right? They have basically free surplus energy, the energy that they produce that they can't sell. It doesn't matter what the price of Bitcoin is. They plug in rigs and they make extra revenue. So I think having something that's not dependent on Bitcoin's price going up to incentivize its usage is awesome, and it's great.
Yeah, and I think it's really interesting how this period of time is aligning with one of the first really pro-cyclical profitable periods for energy companies that we've seen in a while, right? Energy companies and producers have, for the most part, been fairly unprofitable for the last 10 years or so. So I think it's really interesting how in this period where we're starting to see these companies become even more profitable, with energy prices rising, it's really interesting how that aligns with this drawdown in Bitcoin. That's going to make it a lot more cost effective to become involved in the mining space.
Yeah, totally. I mean, the energy companies have crushed it over the last 2 years, and I think there's still a lot of, especially in the oil and gas industry, there's a lot of regulation and just kind of like general conservatism right now, just with how volatile markets have been, that they don't necessarily want to deploy a lot of capital into more capex for oil and gas. So they kind of have a lot of cash just sitting around, and it seems, in my opinion, logical for at least one of them to get seriously involved in the Bitcoin mining space at some point.
Yeah, it makes perfect sense. It's really a win-win situation for everybody. If you guys got any more things you want to add, or things you want to plug, we had a good podcast this week with Joe Consorti. RGO crushed that interview, so definitely go check that out on our YouTube. This whole Twitter space will be up on YouTube later this afternoon if you missed some of it and you want to catch that. So I prefer, well, I mean, obviously I edit those videos, but I don't really watch them because I'm in the Twitter space, of course. But if I were to listen to it, I'd prefer to listen on YouTube, because we put the charts up as we're talking about them, versus if you just wanted to listen to the space on Twitter itself.
Yeah, I just wanted to real quick, I want to plug our podcast from last week that Joe did with Lynn Alden. I think if you're interested in energy and all these topics that we've touched on for the last 10 minutes or so, I think that's kind of the place to go for it. I think it was a great podcast. Joe did a great job, of course, as always.
Thanks, Blake. Yeah, definitely go check it out, guys. I mean, Lynn did a fantastic job with it, as always, and she recently published a report about her thoughts about energy for the next decade, and we covered a lot of that. So definitely check it out. It's Blockware Intelligence on YouTube.
Yeah, definitely check that out. That Lynn episode is fantastic. With that, we can go ahead and hop on out of here. Thank everybody for listening, and we'll be back next Friday. So make sure to check out the newsletter too. It's up in the pinned tweet, and I'll tweet it out from the Blockware account here in a second. So thank everybody for joining.
Yep. Have a great weekend, everyone.
Awesome. Yep. Thanks, Mitch, for hosting, and thanks, Blake, and thanks everybody for listening.